Hello and welcome to episode 169 of the Do More With Your Money show. Today we're going to be discussing the debt ceiling in the US and how that has now come to the fore and has started to impact asset markets. Certainly this was something that has been to the forefront of investors' attention really since the beginning of the year, but now as we approach what's been termed as the X date, or the date when the budget can become more challenging for the US, it's certainly becoming more to the fore from a markets perspective. I'm joined today by Neil from an advice perspective and Paul and Chris from the investment team to really bring this to life and explore what it actually means for markets and what it means for clients as well. But maybe to start with, Neil, maybe just turning to you firstly. Certainly it's been something that's been much more in the news over recent weeks and certainly has ramped up over recent days. Have you seen an increased sort of interest from clients in discussing it? What does it mean, etc.?
Yeah, definitely, Jeff. We've obviously had a rise in calls around this topic in particular. And we do obviously reiterate what the investment team, guidance you guys give us on a day-by-day basis. But what we've found is that we generally tend to point clients in the direction of the morning market videos as well, because obviously everybody on that sat in this room gives their voice and opinion on that, and clients find that really, really informative and really helpful. So yeah, we review those as well. Obviously we chat with you guys on a day-by-day basis, but yeah, there's some good content on there. And also it's very, very accessible for people who use the app straight away on the move on their iPhone or their Android device, and anybody who accesses the client site. So I would recommend anybody who wants an overview of that and to see how it's affecting the markets to check it out on the app. Or to check it out on YouTube on the videos.
Okay. And I suppose what we'll try to do today is just to add to that content through this discussion and bring to life maybe some of those points that people are wanting to discuss. And maybe firstly, Paul, maybe turning to you, what is the US debt ceiling and why does it matter?
Yeah, sure. So the debt ceiling is really the amount of money that the government can borrow. And you can probably think about this as credit cards. If you have a credit card, you can only borrow so much. You have a limit, so credit limit. Or for the government, you have a debt ceiling limit, so they can only borrow so much. And why does the government need to borrow? Well, they are spending more than what they're receiving from tax receipts. So I think the debt ceiling limit is 31 trillion, so it's huge, and it's expanded over time, and that's natural to expand because the economy gets bigger. There's more people in the US. Now, in order to raise the debt ceiling, you have to go through Congress, and so the House of Representatives, controlled by the Republicans, and the Senate, controlled marginally by the Democrats, have to negotiate with each other. So it's a bit of a political game in order to get the debt ceiling passed and get it raised.
And it's probably become more of an issue in the last 20 to 30 years as we've moved from running a fiscal surplus to actually a deficit. So that borrowing is crucial, as you say, to fund the needs of the government.
Absolutely. And over the last 20 years, they've had to borrow 25 trillion. So it has really ramped up over the last 20 years because you've had, more investment needed. You've had financial crisis. You've had various things. And
what is it that I suppose is bringing it to a fore at this point in time in terms of we seem to be getting very close to a very important date? What's that? What's driving that?
Basically, the getting close to the end where the government runs out of money. It can no longer pay its government officials, its healthcare, its pensioners, and so you're running out of money, and so you get to a point where you need to extend, otherwise you're ultimately going to default.
Mm-hmm. And it's a strange concept. It's really a concept that's only in the US, a small number of other countries. Maybe explain that a little bit, Chris. Why have we got this situation in the US and we don't certainly have it here in the UK, for example?
Yeah, sure. It's a good point. If we look in the Western world, I think currently probably only Denmark has something that is equivalent. So only Denmark has an equivalent debt ceiling. If we think of what other countries do, so some countries have what we call a debt break. So where you get to a certain level of debt compared to GDP, then that is the equivalent of their debt ceiling. So you see that in countries such as, say, Poland or Germany, other countries maybe such as us, the UK. We don't set formal limits on public borrowing to meet legal obligations, but maybe just kind of reversing back and thinking a little bit about Denmark, and I think this is quite interesting actually. So Denmark, they set up their debt ceiling in 1993, and what they did is they left a lot of headroom between the level of debt and the ceiling. They then raised that debt ceiling in, I think it was 2010, in the aftermath of the financial crisis. But probably for me, the kind of key differences between what the US is doing and what the Denmark is doing is really, firstly, Denmark have much lower levels of debt compared to GDP. So I think the figure that is right now is around about 37%. That compares to the US, which is 126%. I think the second point is the significant headroom. But probably the third point is it's not seen as a political tool. It's not seen as a tool to be used to gain political power, which is exactly what we're seeing in the US right now.
Which I suppose is the contrast, because when you go back to when the debt ceiling in the US was established, it wasn't meant to be a political tool. It was very much meant to be a way for the Treasury to manage the economy without having to constantly come back to Congress for approval, whereas now it has become much more politicised, as Paul brings out, in terms of the trading between the two. And it's interesting, just looking back over the past 60 years, it gives you a sense of how the debt ceiling has evolved. It's been increased 78 times. So it's not as if this is a new phenomena. It's just something that we're coming up against on a more regular and more frequent basis as a result. I suppose to maybe give our listeners and our viewers some sense of how history has helped us understand that, what does history teach us? What has tended to happen as we've approached these periods in the past? And Paul, do you maybe have some thoughts to share there?
I suppose, as you point out, history tells us that 78 times this has happened before, and it's always been agreed. Now, we can go perhaps to 2011, anchor on that, where you had the House of Representatives controlled by the Republicans. The House demanded that Obama would negotiate a deficit reduction package in exchange for raising the debt ceiling. 2 days before the US government would run out the money, they managed to get a deal sorted out. So it does tend to get very close to the deadline. So naturally, people get concerned. You see a pickup in volatility within markets. These are natural effects of it. But we can use these points to anchor on to see what may play out. But ultimately, a debt ceiling gets agreed to be raised because the other consequences, is
quite significant.
Absolutely.
I suppose that point, Neil, is probably what you've been having to deal with, just that volatility that it engenders into asset prices and how clients see that coming through into their portfolios.
Yeah, definitely. We have a laugh sometimes because we have the technology, obviously, where you can see an instant valuation of your investments, and a lot of people look at it and they can see sometimes where it goes up a bit more and goes down a bit more and goes up a bit more on their phone. And we encourage clients not to look every day, because if you take an account of that volatility and you're thinking, wow, this market's really, but this is a short-term thing. This is a pretty short-term thing in most people's investment journeys, which we always talk about. Look at the medium to long term. And if we have a look at the historic events which have happened over the last 2 to 3 years, it's still a relatively short period of time. So, the conversations that we have with clients are remain calm, take advice from the experts, watch the morning markets, and then that'll sort of give you an idea of what's going on. But also as well, I think there's a great deal of optimism amongst investors as well as to, looking at medium to long-term growth.
I think, the other point to bring out there, it's all about politics, isn't it? It's how politics are actually influencing asset prices in the real economy, and that's probably where we're starting to see that subtle change that Paul's alluded to, where there's much more of a political debate around raising the debt ceiling, and it is about trading off between different policy agendas between the Democrats and the Republicans. And Chris, I know you've been sort of looking at that from a party political perspective. What are some of the things that they're discussing or they want to change, recognising, I suppose, one of the things we maybe haven't touched on much is the success of Biden's legislative agenda. He has been able to achieve a lot, but that requires funding as well.
Yeah, I mean, it's quite interesting. I think if you think about it, you're trying to get agreement between two opposing political parties. Now, imagine if you had that in the UK and you tried to get agreement between Conservative and Labour. There would be so much discussion. It would very probably go right the way to the wire. There would be quite a lot of problems along the way, and that's exactly what you're seeing. So what you're seeing is, in exchange for support for raising the debt ceiling, the Republicans are demanding budget cuts. So they want $4.5 trillion worth of budget cuts to come through. And what will that do? Well, that will scupper some of Joe Biden's legislative policies that he has been very successful in bringing through. Now, there's certain things that have been taken off the table in respect of the cuts, so they're not going to be cut. So things like Medicare, Social Security. There's an agreement not to raise the retirement age, obviously with people living longer. Yeah. That's one of the key causes of spiralling US debt. But maybe just thinking about some of the things that are on the table to be cut, things like funds for education, electric cars, rail safety, law enforcement. And what could that mean? Well, what that could do is potentially lead to weaker US economic growth for this year into next year. I was reading it's a comment that I've just written down, and it was from the White House, and they described the Republican proposal as a blueprint to devastate hardworking American families. But actually, when you dig into that, there's got to be some sort of budgetary concessions between them. But maybe just one other point, just sort of building on what Paul was saying. And Paul, you were talking about Obama and 2011 and the budget cuts that were agreed to there. As time moves on, lawmakers can actually bypass them. So even though there is an agreement at a point in time, as the years move on, potentially that agreement can dissipate and they can bypass them overall. But I think the thing for me is you've got to get agreement between two parties who are competing against each other. And that's why it's been so difficult, and that's why we are where we are right now.
I suppose it also plays into the electoral calendar that we have to an extent as well in the US, with a number of different candidates and both parties starting to declare their interest in running for presidency as we look forward as well. So that certainly seems to be playing a little bit into it. But interesting, I suppose, overnight, a bit more positive news in terms of the magnitude of the gap between the two parties. It seems to be a bit closer than it certainly was yesterday morning.
Yeah, I mean, I was reading the Financial Times this morning, and it feels like things are much closer. You're seeing much more positive news coming from the various different parties. Obviously, time is tight. We do have that deadline, but right now it feels like it's getting closer.
In terms of that deadline, is it a specific day where this all stops, or is there something? Is there a movable feast around when it happens?
I think Janet Yellen has come out and said 1st of June is the expectation. Now that's been brought forward because the tax receipts, the revenues that the government has received in April, weren't as large as what they expected. So the deadline's been brought forward.
Okay, and that's what people are sort of saying. X date is this, and I suppose that was kind of maybe what Fitch were alluding to a little bit in their report yesterday, suggesting that AAA rating for the US could be under a degree of scrutiny, shall we say, if we don't get this resolved.
Exactly. The consequences are quite large. You'll see people out of work, unemployment would rise. And that would have knock-on effects to economic growth. There'd be financial instability as well. So it's not surprising that Fitch are coming out and looking that potentially they would downgrade the credit rating of the US. We saw that in 2011. The S&P rating agency did that. Yeah,
And I suppose you've alluded to there, really the problems are quite significant.
Yeah.
Should one reach this date, and that's probably what it is that brings the political spectrum together to resolve it, because really it's in neither party's interest to have caused such a situation to evolve within the economy.
Exactly. The political backlash, thinking about the election in 18 months' time for Joe Biden, if this doesn't get solved and the debt ceiling going, you can't have people not getting paid, people out of work. It's just...
And are there different options in terms of, say we get to the end of the month and it's not reached an agreement, but could they suspend the debt ceiling and then just have ongoing discussions to get it resolved? Is there a need to definitively raise it, or how does it play through?
I think they'll have the flexibility to push it back if needed.
Okay. And I suppose you've maybe, Paul, touched there on volatility and going back to 2011, 2013. How does that play out in asset markets at that point in time?
I think, going back to 2011, just the fiscal cuts that they had to make and what that meant for future economic growth, you saw initial weakness in the stock market in the months after they actually agreed to raise the debt ceiling. And you saw a pickup in volatility in bond markets. You saw gold do well. But that volatility actually created quite a lot of opportunity for active managers, because you see some weakness, you've got cash on the side, you can actually deploy that where you see. So it is the pickup in volatility can actually be a good thing.
Yeah.
And also you've got to think, this is why we emphasise diversification globally across different asset classes, because it helps you minimise that volatility, but also gives you plenty of opportunities where you see them.
I think it's quite interesting. Actually, I was just looking through the stats for 2011, so just to see what the US equity market, so what US company shares did, and what US Treasuries did, so what US government bonds did. So initially, you did see a sell-off in equity. So peak to trough, it fell around 17%. But if you look at what US equities did over the year, they actually finished very slightly up. They were up just over 2%. But then actually, if you look at what happened in the years after that, you saw 2012, they were up 16%, 2013, they were up 32%, 2014, they were up 14%. So it was quite interesting. We were talking about this before, and we were talking to one of the economists we speak to, so someone you'll know well, Jeff, a guy called Jim Soloway at SEI, and he actually said that the debt ceiling failure, if you want to call it that, in 2011 actually provided a pretty incredible buying opportunity in equity markets. I think if you look at what happened within bond markets, US Treasuries, so 10-year, were up 15.9% in 2011. Now, bear in mind, they're a very low-risk asset where you tend to receive much lower returns than equities. So what you actually saw was a pretty incredible return from them, and that's because you saw investors, what you have like a flight to quality, so where they're basically reducing risk within their portfolios and looking to lower risk assets. So I think the key thing for me, and this is probably repeating in some ways what Paul said, but we're multi-asset. We're invested in lots of different types of assets. Some will do well at certain points in time, some will do well at other points in time. I actually think 2011 is probably a really good example of that.
I think it's just important to, we often look back in history, try and draw parallels or comparisons of what might happen in the future, but we also, thinking about 2011, what also was taking place was the Eurozone debt crisis. So, that's a completely different dynamic, very particularly to that point of time that we don't have right now. So we have to be careful also thinking about...
I think that's a great point to bring out, because if we think back to where we were post-financial crisis in that period of time, we had interest rates effectively pinned at zero as well at that point in time. And also we had no inflation. So we've got a very different, potentially, environment today with how interest rates have had to move to deal with inflation over the last 16 to 18 months. So much higher starting point for interest rates today than we did in 2011, and certainly inflation at much higher levels than we saw then. So there are potential information to draw from that, but whether it's a parallel, as you rightly say, Paul, is quite a challenging leap to make, just given those big differences
Absolutely.
in the backdrop.
Absolutely.
Chris, maybe just in terms of the portfolios themselves, just that linkage between the US equities, US bonds in the portfolios, and how do you, from the true potential portfolios perspective, think about some of those points we've just been making on the debt ceiling, bond markets, inflation, how it feeds into the portfolios?
Yeah, it's a good question. I mean, maybe just starting with what I'd almost describe as kind of US dominance within asset classes. So just to try and break that down for you, if you think of world equities, and we think of the main world equity index, so the All Countries World Equity Index, if we look at that regionally, so around 61% of that currently is the US, so more than half of that is US equities. If we then think around the government bond market and we look at US treasuries, 39% of world government bonds are US. So what does that mean? It basically means that the US is the dominant force in listed assets overall. Now, if we think around how we're positioned within TPP, so say if I just take US equities there, I was just looking at the latest fact sheet, we've got around 24.7% in US equities. Overall, we've got 53.8% in equity. So we've got around about 46% of our equity book is invested in US equities.
And that's
so
in the balanced
that's
strategy.
in the balanced strategy, yeah. Now, you compare that 46 to the 61, we've got a lower weighting to US equities compared to the index. So structurally, we prefer to have more regional diversification compared to that index overall. And then maybe just finally, just thinking around how the portfolios are positioned, we've got a lot of what I describe as hedges within the portfolios. So that could be things such as government bonds. It could be things such as more defensive currencies, so things like Japanese yen, Swiss franc, even maybe slightly paradoxically the US dollar. That might sound weird when we're talking about the US debt ceiling crisis. So for us, we believe that we're actually positioned very well right now. We're not positioning around the debt ceiling because it's a political event. You don't know how that will pan out. However, we're positioned right now quite defensively, and that will work well.
And I suppose, Paul, maybe to bring that to life a little bit in sense of how markets have reacted to some of the discussions around the debt ceiling. We've seen sort of those US T-bills that mature around that date, pricing change quite materially over recent days.
Yeah, so we're talking US government bonds, known as T-bills, which are very, very short in maturity, so maturing in 1 month or 3 months' time. You've seen those yields really blow out, gone higher, because they're starting to price in the risk that the US government defaults, i.e. the debt ceiling doesn't get raised. So it's natural that the market does have to price something in. There is a risk. It is a low probability, and so you've seen that come through in the bond market. But we've seen it. It is quite volatile as well.
Yeah.
You have to.
And I suppose as well that thing that we have also seen over recent days is the dollar on a trade weighted basis just continue to move that little bit stronger, which is, as Chris says, a relatively odd dynamic when we're discussing the challenges that potentially faces as well.
It is. You can think, well, if the US government defaults, then does that mean slower growth for the US and the dollar should weaken? But then it's also viewed as a safe haven currency. Dollars, there's so many different dynamics pulling it different directions. If you think about some of the data that's come out from the US, it's been a bit more stronger relative to the likes of Europe, where we're seeing very weak data in Germany. So there's a number of factors playing through, but we have seen a bit more strength in the dollar.
And I suppose as well, Neil, it probably brings to the fore, just as the guys have been discussing, politics and just how that feeds into volatility for our clients, and just something, again, as you were saying, for everybody to either subscribe to morning markets, really, to keep up to speed on those developments.
Yeah, definitely. We've got a lot of astute investors. We've got a lot of savvy investors who are well up on political events and want to know, the changes that are being made in the portfolios. And I think it was a great point, which we try to plug to every client, and the global diversification, how that really works when we're encountering political events or volatility, and how we manage to keep that volatility down in certain times of where the portfolios are really tested. Morning markets, I definitely think that we should point clients in the direction of those, because they are a great source, and they're every day.
Okay.
So really good source of information.
Well, we'll maybe leave it there today. Thank you for joining us on the discussion of the US debt ceiling, and please, as Neil says, do subscribe to Morning Markets and our Do More with Your Money show. Thank you.